Welcome back to the deep dive. Today, we're really getting into something fundamental, uh, foundational even, to how the whole global economy works. Corporate financial reporting.
Yeah, we're tackling the rule books themselves, the actual standards.
Exactly. These complex documents, the standards that dictate precisely how companies tell their story, financially and operationally, to everyone watching.
Yeah.
Investors, regulators.
Right. And look, these sources, they're technical. Let's be honest. They're full of jargon.
Definitely.
So our mission today isn't to, read you the rule book verbatim. Think of us more as guides.
What guides, yeah.
We want to pull out the really core ideas, those conceptual pillars, and maybe some surprising details that genuinely shape how companies calculate the numbers you see.
So you walk away understanding a bit more about what's underneath the balance sheet, those hidden assumptions.
Exactly.
Okay, so it's kind of a scavenger hunt for insight then. We'll look at the why behind these rules. Why do they even exist? How companies try to measure risk and uncertainty, which sounds subjective, but the rules are pretty specific.
Surprisingly specific sometimes.
Then the life cycle of assets, how they're valued, how they're disposed of.
And finally, what those investor ratios, the ones everyone quotes, really tell you about a company's health and maybe its future.
It's about getting beyond just the calculation, right? Understanding the choices made.
That's the key. The policy choices matter hugely.
Okay, let's unpack this first bit. We've got these huge sets of rules, IFRS, GAAP. Why bother with this overarching thing, this conceptual framework sitting on top? Why not just write a specific rule for every single transaction?
Well, you've hit the nail on the head. It's because you can't possibly write a rule for every transaction. It's just impossible.
Right.
If you tried, the people setting the standards, they'd just be constantly playing catch-up. The sources call it firefighting. So the main job of the conceptual framework, the CF, is to make sure all the specific standards, like the one for leases, IFRS 16, or IAS 37 for provisions, are built on principles everyone agrees on. Consistent principles.
Okay, so it provides a foundation, stops it being piecemeal.
Exactly. And that consistency is crucial, especially, like you said, when new things pop up in business.
Right, a new type of transaction no one's seen before.
Yeah. If there isn't a specific standard yet, the CF gives the companies preparing the accounts and their auditors a kind of map. It helps them handle it in a way that fits the overall goals of reporting.
Makes sense.
And there's a philosophical point, too. The standard setters tend to believe that standards based on principles are actually harder for companies to, let's say, creatively interpret or get around.
Harder to game.
Yeah, harder to game than just a huge pile of very detailed, rigid rules.
Okay. And what are those fundamental goals then? You mentioned usefulness. What makes financial information actually useful to someone like an investor?
There are two really fundamental characteristics: relevance and faithful representation.
Relevance and faithful representation.
Relevance basically means the information has to be capable of making a difference to your decisions, your economic decisions.
And it has to be timely, I guess. No good getting it a year late.
Absolutely. Part of relevance is timeliness. And relevant information usually has predictive value. It helps you forecast the future, or it has confirmatory value, helping you check past predictions, or sometimes both.
Okay. And faithful representation, that sounds straightforward. It needs to actually represent what happened. But I imagine that's the really tricky one in practice.
Oh, it's the constant challenge. For information to be faithfully represented, the ideal is that it's complete, it's neutral, so unbiased, and it's free from error.
Easy to say.
Very easy to say. When you look at a number for an asset or liability, you need some confidence that the way it was measured genuinely captures the economic reality of that thing.
It's interesting, though, how these big ideas fit together. The sources are clear. The framework itself isn't an IFRS standard.
That's right.
And if there's a clash, say, between the general idea in the framework and a specific rule in an IFRS standard.
The specific standard wins. Every time.
The rule of law, as it were.
Exactly. The standard overrides the framework. But the framework is like the Constitution, ensuring all the individual laws, the standards, are made in a consistent way.
Sets the stage nicely. Okay, let's move into an area that definitely needs judgment. Uncertainty. Provisions and contingencies. IAS 37 territory.
Right, so a provision. Think of it as a liability the company knows it has, but there's uncertainty about the exact timing or the exact amount.
Like warranty claims, or maybe environmental cleanup costs down the line.
Perfect examples. Those are classic provisions.
So if they don't know the exact amount or date, how do they decide whether to actually put it on the balance sheet? What are the hurdles?
There are 3 key criteria. They all have to be met.
Okay.
First, there has to be a present obligation because it's something that already happened, a past event. You can't create a provision for something you just might decide to do later.
Got it. Must be a current obligation from the past. What's second?
Second, it has to be probable that the company will have to give up economic resources to settle it. Cash, usually.
Probable. How probable is probable? Is there a percentage?
Generally, yes. It's usually taken to mean more likely than not. So greater than a 50% chance of having to pay out.
Okay, over 50%. And the third criterion?
Third, you have to be able to make a reliable estimate of the amount. If it's one single obligation, you estimate that. If it's made up of lots of similar items, like thousands of small warranty claims,
Right.
then you'd use expected values. You look at the range of possible outcomes and their probabilities to get the best estimate.
Okay, that makes sense. But what if it's not probable? What if the chance of paying out is, say, 30%? The company knows it might have to pay, but it's not likely. That's where contingencies come in.
Exactly. That's a contingent liability. It's a possible obligation or maybe a present obligation where the payout isn't probable or you just can't estimate it reliably.
So it doesn't go on the balance sheet.
No. The rule is pretty clear here. If payment is probable over 50%, you recognize their provision
On the balance sheet.
on the balance sheet.
Yeah.
If payment is only possible less than 50%, but not remote, you don't put it on the balance sheet, but you must disclose it in the notes. Tell people about it.
Okay. And if the chance is really tiny, remote?
If it's remote, you do nothing. Don't recognize it, don't disclose it. It's considered too unlikely to worry about.
Okay, so provisions on the balance sheet, possible liabilities disclosed in the notes, remote ones ignored. Makes sense. What about the other side? Contingent assets. Potential wins for the company.
Contingent assets.
Yeah.
So this is a possible asset that comes from a past event. Maybe the company is suing someone and might win damages.
How are they treated? Did they get recognized?
No, the rules are much stricter, much more conservative here. You do not recognize a contingent asset in the financial statements.
Not all.
Not unless receiving it is virtually certain, which is a very high bar.
So almost guaranteed.
Pretty much. If the inflow is just probable, remember, probable meant 50% for liabilities, you can disclose it in the notes, but you absolutely do not put it on the balance sheet as an asset.
You don't count your chickens before they hatch, basically.
Exactly. Especially when it comes to potential income or assets. Very prudent approach.
That caution really comes through. Okay, we've talked liabilities. Let's flip over to the asset side. Property, plant, and equipment, PPE, big factories, machinery, IAS 16 territory. How are these valued? 2 main ways, right?
That's right. The 2 models are the cost model and the revaluation model.
Cost model sounds simple enough.
It is. You carry the asset at what it originally cost, less all the depreciation charged over its life so far. Straightforward.
And the revaluation model.
The revaluation model lets the company carry the asset at its current fair value instead. So what it's worth now. This often means its value on the balance sheet is quite different, usually higher than its depreciated historical cost.
Now, here's the bit I find fascinating, the revaluation twist. If a company revalues, say, its headquarters building and its value has shot up, that gain doesn't just flow into the main profit figure on the income statement, does it?
No, it doesn't. Not directly, anyway.
So where does it go? And why should an investor care where it goes?
That gain goes into a special section of equity, the owner's stake in the company, called the revaluation surplus.
Revaluation surplus? Okay.
And technically, it gets there by first passing through something called other comprehensive income, or OCI.
OCI. Sounds like a sort of side account for income.
That's a good way to think about it. OCI is like a holding area for certain gains and losses that haven't been realized yet, usually through a sale. So the company is worth more on paper because the building's value went up.
Right.
But that gain hasn't boosted the main profit figure, the one used for calculating earnings per share, for example. It keeps the reported operational profit figure cleaner, in a way.
And there's a catch with revaluation, isn't there? You can't just pick your best performing asset to revalue.
Absolutely not. Consistency is key. If management decides to revalue one asset, say, one machine, they must revalue the entire class of assets that machine belongs to. All similar machines, for instance.
So all land and buildings, or all plant and machinery, you can't cherry pick.
No cherry picking allowed.
Yeah.
It prevents companies from only revaluing the winners and hiding the losers carried at cost.
Okay, following that asset's life, what if the company stops using that machine for production? They decide, right, we're going to sell this off. It's surplus now. Does that change things?
Yes. significantly. It potentially falls under a different standard then. IFRS 5, assets held for sale.
Held for sale. Sounds specific. What makes an asset held for sale?
There's a strict checklist. Management has to be committed to a plan to sell it. The asset needs to be available for immediate sale right now in its current condition.
Okay.
They need to have started an active program to find a buyer. The sale has to be highly probable expected within the next 12 months.
12 months, okay.
And it needs to be actively marketed at a reasonable price relative to its fair value. And importantly, management actions must show they're unlikely to change their mind about selling it.
That's quite a few hurdles. So once it ticks all those boxes, how is it valued? Does it stay on the old model?
No, the valuation rule changes immediately. As soon as it's classified as hold for sale, the asset is measured at the lower of its current carrying amount, its book value under the old model, cost or revalued, and its fair value less the cost you'd incur to sell it.
Lower of carrying amount or fair value, less costs to sell. Why lower?
It's prudence again. It ensures the company doesn't carry the asset at a value higher than what they realistically expect to get for it, net of selling costs. It anticipates the potential cash inflow more conservatively.
Right, prevents overstating assets just before they're sold. That makes sense. Okay, let's zoom out a bit for the final section. The bigger picture groups of companies and how investors use all this data. Group accounting first. We often see consolidated accounts where a parent and subsidiary are treated as one. What's the trigger for that?
The absolute key concept is control. If a parent company controls a subsidiary, then even though they are legally separate companies, the accounting rules require consolidated financial statements.
Treating them as a single economic entity.
Exactly. And control isn't just about owning shares. It means the parent is exposed to variable returns from the subsidiary profits, losses, and crucially, has the current ability to affect those returns through its power over the subsidiary, power to direct its activities.
Okay, so it's about power and exposure to returns. But what if the parent doesn't have full control? Maybe they own, say, 30%. Enough to have a say, but not dictate everything.
Then we're usually talking about an associate, which is covered by a different standard, IAS 28.
Right, associate.
The threshold there is significant influence. The investor, the parent in your example, has the power to participate in the financial and operating policy decisions. Maybe they have a board seat, but they don't control those policies.
So influence, not control. And that's accounted for differently, not full consolidation.
Correct. It typically uses something called the equity method of accounting, which reflects the investor's share of the associate's profit or loss, but doesn't combine all the assets and liabilities line by line like consolidation does.
Okay. Now, back to consolidation. When you merge the parent and subs accounts, you have to clean things up internally, right? Eliminate transactions between them.
Oh, absolutely vital.
Yeah.
You have to eliminate intragroup transactions to avoid double counting or artificially inflating figures.
Like what?
Well, the big ones are intragroup sales. If the parent sells goods to the sub, or vice versa, you have to remove that sale and the corresponding cost of sale from the consolidated income statement.
Because from the group's perspective, no sale to an outside party actually happened yet.
Precisely. And crucially, you also have to eliminate any unrealized profit made on those internal sales if the goods are still held within the group at year-end.
Unrealized profit, often called PUP, provision for unrealized profit.
That's the one, PUP. Imagine the subsidiary makes a widget for $10 and sells it to the parent for $15. The sub records a $5 profit. But if the parent still has that widget in its inventory at the end of the year,
the group hasn't actually earned that $5 from the outside world yet.
Exactly.
Yeah.
So in the consolidated accounts, you have to remove that $5 profit from the inventory value and from the group's overall profit until the parent sells the widget to an external customer. Same logic applies if one group company sells a non-current asset like a machine to another at a profit.
Right. Makes the consolidated figures reflect the true economic substance for the group as a whole. Okay, finally, let's look at how investors use these numbers. Two key ratios often quoted, PE ratio and diluted EPS. What's the takeaway message from a high PE ratio?
The price earnings, or PE ratio, is really a measure of market sentiment, market expectation. Confidence, exactly. A high PE ratio suggests that shareholders, the market, have strong confidence in that company's future prospects. They expect profits to grow significantly.
So they're willing to pay a higher price today for each dollar of current earnings, betting on much higher earnings tomorrow.
That's it. They're paying a premium for expected growth.
Okay. And diluted EPS. Basic EPS is just earnings divided by shares. What does diluted add? It sounds a bit negative.
It's sort of the mandatory pessimistic calculation, or perhaps realistic.
The what-if scenario.
Exactly.
Yeah.
Diluted EPS starts with the basic earnings per share calculation, but then adjusts it for the potential impact of things that could become ordinary shares in the future.
Like what sort of things?
The most common are convertible loans debt that can be converted into shares and employee share options.
Ah, right.
Diluted EPS calculates what the EPS would be if all those convertible instruments were converted or those options were exercised. It recognizes that exercising these would increase the total number of shares.
Which would spread the earnings thinner, diluting the EPS for existing shareholders.
Precisely. So it gives a more conservative, worst-case view of EPS, assuming all potential shares come into existence.
But even with metrics like PE and diluted EPS, we need to be careful, right? Ratios aren't the whole story. What are the main limitations we should keep in mind?
Oh, absolutely. Critical thinking is essential. First, ratios are backward-looking. They tell you about the past, but they ignore future plans or actions management might take.
True.
Second, they can be really distorted by differences in accounting policies between companies. If one firm uses the cost model for its buildings and another uses revaluation, comparing their asset turnover ratios or gearing ratios can be misleading. It's not apples to apples.
Good point.
And third, sadly, we always have to remember the potential for creative accounting or, window dressing, making the numbers look a bit better just before the reporting date. Ratios can be manipulated.
So useful tools, but use with caution and understand what's behind them.
That's the message. Understand the inputs to the calculation.
Wow. Okay, we've really covered a lot of ground there, from the big ideas in the conceptual framework that shape everything.
Down to specific rules for provisions, asset valuation, held for sale.
Group accounting complexities like PUP, and finally, how investors try to make sense of it all with ratios.
Yeah, and I think the big takeaway is that reading financial statements isn't just about plugging numbers into ratio formulas. It's really about understanding the policies the company chose.
Like choosing the cost model versus the revaluation model.
Exactly, or how aggressively they provide for warranties. Those choices fundamentally change the reported profit and the balance sheet values you see. It's about reading between the lines, understanding the judgments made.
Okay, so building on that, here's a final thought for you, the listener, to chew on. We learned that when a company classifies an asset as held for sale under IFRS 5, they immediately have to value it at the lower of its carrying amount or its fair value less costs to sell. Think about this. How might that specific rule, the immediate potential write-down the moment they decide to sell, subtly affect how motivated management is to really push for the highest possible selling price?
Interesting.
How might their behavior differ compared to if they just kept carrying it at its old depreciated cost while trying to sell it? Does that immediate valuation hit change the incentives? Something to think about.